All right, here we go. All right, so we're going to pick up where we left off on Tuesday. If I can get my camera to switch, there we go. We were talking about the balance sheet, right? So we're now on to the financial statement, the balance sheet. The balance sheet has two halves. It has the asset side and then the liabilities and owner's equity, which I'm going to abbreviate as OE, right? Those two things have to add up to the same amounts. They're always equal, right? So, if you increase assets, liabilities and owner's equity have to increase. If you decrease assets, liabilities and owner's equity have to decrease. That is the golden rule of the balance sheet. We talked last time about current assets. So quick review, right? We talked about assets. Assets break down into current assets and long-term assets. We add those two together to get the total assets line. Okay, so what was a current asset? The basic rule for current assets, blurry. Thank you. Better? Okay. The basic rule about current assets versus long-term assets is a current asset is a liquid asset. It's going to most likely be used, or it's able to be used within 1 year. Okay? So what are the most liquid assets? Cash, inventory. So cash, obviously, it can be spent immediately, so that makes it perfectly liquid. Inventory and supplies, those are going to be used within a year. They are what we call expendable, meaning you're going to use it and throw it away, right? As opposed to equipment that lasts for multiple years. We're going to get to equipment in a second. Equipment is a kind of asset, but it's a long-term asset, because something like a desk, right, or a computer is going to be used over multiple years. Same with your building, your trucks, your x-ray machines, all those things are long-term assets. So short-term assets or current assets include things like bandages and syringes and pharmaceuticals. Those are all our inventory or supply accounts, depending on how you want to frame it. And then we have a category called current investments, right? Current investments is we take our cash. So we had this long conversation about, having your, having a stash of money to protect yourself in case something goes wrong, right? So organizations have a similar kind of stash of cash that they want to have on hand. So they only keep enough cash on hand to pay their day-to-day bills, but they also keep another cash supply on hand as kind of a slush emergency fund, right? That slush emergency fund, because they don't plan to use it, they put it into something that is slightly less liquid than cash. So they don't keep it in their checking account. They put it in something that's interest-bearing, but really easy to convert. The classic example would be treasury bills. So they probably have an account where they are able to push money into treasury bills, and they can liquidate those by making a phone call. But it's not instant, right? It's maybe a 24-hour turnaround where they have to turn it around, and they're making some small amount of interest on it. But it's better to make a small amount of interest than to make zero interest, right? So those are examples. We talked about accounts receivable, right? So accounts receivable, these are all our current assets. Accounts receivable, those are the IOUs that we get from AR. I'm going to abbreviate A/R, accounts receivable. Accounts receivable are all those IOUs that our accrual basis business gets from our buyers. So typically, we are rendering a service on one day, sending out a bill and getting paid 30 days later, right? When that bill goes out, it becomes an account receivable. We book it as revenue, but we don't have cash. We have an account receivable, an IOU basically, on our books, right? And so every hospital, every clinic, every healthcare organization is going to have a large accounts receivable account in its current assets. Why is it current? Why are accounts receivable current? Because we expect to be paid within 30, 45 days, hopefully, maybe 60 days, right? If it goes much beyond that, then it potentially turns into a doubtful account. So we have these accounts receivable that we're keeping track of and managing, but they are expected to be paid in under a year, hence current asset. Okay, so we talked about all that last time. That's what we spent last time talking about. So current assets, then under assets, we have long-term assets, which is the next section. And what do we have under long-term assets? So I started to talk about financial assets and real assets. Question? So the question was, are accounts receivable only an asset under accrual basis? Yes. So you wouldn't manage your account, you wouldn't even pay attention to your accounts receivable under a cash-based business. You're only booking things when cash comes or goes. So under an accrual basis, we're going to have accounts receivable. So, good question. Okay, so we're going to have real assets and financial assets. We use the term real asset in a technical sense, in the sense like, of course financial assets are real, like, this is not like the Matrix where you take the red pill or the blue pill, right? They are all real assets, but in the technical sense, a real asset refers to a physical thing, right? For the most part. There are some variations, but you can think about it that way. Like a thing that the organization is actually going to use to do its business is a real asset. So we talk about real property, meaning physical table, chairs, those are real assets. Financial assets, such as long-term investments, right? So this is an example of a financial asset. And this would be things like the hospital owns a portfolio of stocks and bonds and other kinds of, maybe they own some property that they don't hold. They are not holding with the intention of building a hospital on it. They might own a piece of property that, has retail business on it or something like that. Those could, as long as they're being held, the key there is they're being held as an investment, not as an operational asset. Okay? Mostly think stocks and bonds. That just makes it simple, right? You're not going to use a stock to run your hospital. You're not going to use stock shares of stock to run your hospital. So that's so those are examples of long-term investments. Most not-for-profit entities have large, especially if they've been around for a while, have large amounts of long-term assets in the form of investments. The reason is, instead of paying taxes, they save some of that money because the purpose of that money is to help fund capital replacement. So when it's time to build a new hospital, for example, they will draw on some of their long-term assets. They'll sell off some of their investments in order to help fund capital replacement. Some of that money comes to them by virtue of the fact that they don't pay taxes. So not-for-profits tend to have some of the money that they save by not paying taxes, they stick into these into this fund, right, which they then use to replace their or increase their capital. Capital meaning physical capital, physical plant. So I'll use the phrase capital to refer to real assets a lot of times. Okay, so one of the differences when you look at a balance sheet between a for-profit and a not-for-profit is not-for-profits will tend to have a fair amount of these long-term investments. For-profits tend not to. They tend to pay it out in dividends if they have excess resources, and then when they need additional capital to do something, they will go back to the market, either raise more equity funding, meaning they'll take investors will give them money in order to have a portion of the ownership. They'll use other mechanisms of funding, but for-profit entities tend not to hold large long-term asset funds. Not-for-profits do, and I'll show you a real not-for-profit balance sheet in a little bit. But you'll see they have this large amount of money stashed away in long-term investments. Okay, One of the things that's interesting about financial investments or financial assets is they are reported at fair market value. And what does that mean? If you are a stock investor and you have a portfolio of stocks, so you own some stock in Amazon and some stock in Genesis and some stock in HCA, right? At the end of the day, maybe you go home after all your classes and you log on to your brokerage account and you see the share prices of all the stock you own, and then at the bottom of your statement is how much is your portfolio worth, right? When we go to create a balance sheet, when we go to publish a balance sheet, remember, it is a snapshot in time, right? So this balance sheet is maybe as of December 31st, right? So the dollar amount that is reported for long-term investments, if they're financial assets, the dollar amount reported on the balance sheet is the dollar value of the brokerage account on December 31st. Now, most of you are like, well, of course, why wouldn't you do something else, right? Well, actually, as it turns out, this is kind of unique on the rest of because the rest of the balance sheet is reported on historical basis. So we'll get into what that means here in a second. So the thing to remember about financial assets is they are reported at fair market value, meaning the value of the assets according to the market on the date that the balance sheet is constructed. Right, so whatever the fair market value of the portfolio of investments was on December 31st, that's the value that gets reported on the balance sheet. If the stock market takes a 50% crash on January 3rd, it doesn't matter. You still report the December 31st value, right? So we have long-term investments. So continuing with long-term assets, the category of long-term assets. So long-term assets, we have long-term investments. We then have probably the next most important thing. Yeah, I'm just going to cover these two things here. The other most important thing is category called property, plant, and equipment. I will refer to it as PPE. This is all of the stuff, the physical stuff that an organization owns. This is the desks and the buildings and the vehicles and the equipment inside the organization. So we have a couple of lines, depending on how you look at and the level of detail of the balance sheet you're looking at. You may have a line called gross, and I'm just going to abbreviate gross property, plant, and equipment. This is reported on a historical basis. It is based on the value at the time of purchase. Okay, so the university bought me my laptop, a year and a half ago, right? And it was like $1,000. If we were building the university's balance sheet, my laptop would be an asset for them, and it would be a long-term asset because they expect me to use it for like 4 years, right? 3-4 years. So it's not going to be used up in 1 year. So they're not going to expense it and have it be inventory or a current asset, right? Because it's expected to last more than 1 year, it's a long-term asset, specifically property, plant, and equipment. So my laptop, so they would have let's say they have their gross PPE line. If the only thing the university owned was my laptop, then they would report on the gross PPE line $1,000. purchase price of my laptop. That never changes. As long as the university still has, as long as I have my laptop, excuse me, and it remains property of the university, their gross PPE line will have $1,000. Now, their gross PPE line doesn't just have my laptop, obviously, right? It has all of the buildings on campus, right? All of the little white vans that drive around, and get on the sidewalks all the time, right? All of the desks and chairs, all of the computers, right? Everything, right? Everything that the university has is in that gross PPE line at the price that they paid for it. So maybe they bought these tables 5 years ago, and they cost $200 each. Whatever, I don't know, I'm just making up a number, right? 200 times however many are in the room. That would be, and then multiply that by all the classrooms across the campus. So even though they're 5 years old, even though my computer is, let's say, 2 years old, it's still being carried at its purchase price in the gross line. Right? But what did we talk about with the income statement? You've got these things that are expensive that you buy, right? You pay, so like a hospital spends $100 million on building a new hospital. And we said, well, you don't charge yourself $100 million the year you build the hospital, right? What do? What is it again? Very good. You spread the cost of the cost on the income statement over the lifetime of the asset. What do we call that charge on the income statement? Depreciation, right? So with my laptop, using a simple example, let's imagine my laptop has a 4-year life, right? So if my laptop has a 4-year life and it costs $1,000, if we're going to do straight line depreciation, I would take 1,000 divided by 4, and I would take a $250 depreciation charge each year for my laptop, okay? So what I'm going to have is an adjusting account along with my gross PPE. I'm going to have an adjusting account. It's not an expense, right? It's not a liability. A lot of students get confused, right? It is an adjusting account called accumulated depreciation. Accumulated depreciation, okay? Accumulated depreciation is the amount of depreciation that has been charged against a particular asset. So if the university has my $1,000 laptop and it's expected to be a 4-year life, right? They're going to charge themselves $250 per year in depreciation. That reduces reduces the value of the property, plant, and equipment that we have on our books, so that we get to what's called net property, plant, and equipment. So net property, plant, and equipment, net PPE, is going to be gross PPE, the original purchase price of the equipment, minus the accumulated depreciation will give us the net PPE. So if my laptop is, yes. Accumulated depreciation is the sum of all of the depreciation that's been charged against all of the assets owned by the organization. But like say in my computer example, it would be, so we'll run, what I want to do is walk through that real quick. You have a question or stretch? Keep going? All right. So my laptop cost $1,000. In year 1, the university charges itself $250 on the income statement, right? So now the accumulated depreciation after year 1 is $250. We had gross PPE 1,000, accumulated depreciation after year 1 of 250, net PPE 750, right? So that's year 1. Year 2, gross PPE 1,000, doesn't change, right? Accumulated depreciation After 2 years, how much is the accumulated depreciation? 500, right? Because we're taking a $250 charge each year. And so net PPE is 500. Does that make sense? Okay. So after 2 years, right, my accumulated depreciation is now 500. So a lot of times you will see on a balance sheet reported, they'll skip the gross, they'll skip the accumulated, and they'll just show net PPE line, and then it'll have a footnote saying refer to footnote 7, and then it'll run through we have gross balance of $7 zillion, and then we have accumulated depreciation of $4 zillion, and so our net PPE is $3 zillion, right? But they'll only show you it is not uncommon for them to just show you the net PPE line and then say, see the notes for more details. But I will probably ask you to do this as part of your calculations. Okay? So those are two of the most common long-term assets. So the key point here is the property, plant, and equipment, the real property on a balance sheet, is not reported at the actual value, at the market value, right? It's reported at purchase value. So if you have a hospital sitting on a piece of land, so take Exeter Hospital, right? Back in the 50s, when they built Exeter Hospital, it was probably out in the middle of nowhere, right? Probably in a cow field or something, off by itself. Now it's in the middle of town. Right? The property value that hospital sits on is way more valuable than it was when they bought it. Still carried at historical cost. Yes, ma'am.
So they would have account for the depreciation of the land, but then it would be in value, so that would never be counted on their balance sheet. Does that make sense? Obviously, over the course of however long they use that land,
yep,
they're accounting for the depreciation of the land just because they have to pay it off. But then the land value goes up, so the increase in value just never gets accounted for until they sell it.
Exactly. So let me pause. So yes and no to your example, and I didn't make that clear. So one thing that doesn't ever get depreciated actually is land. Buildings, equipment, right? Land doesn't wear out. Right, the idea, the conceptual idea is land doesn't get depreciated, but the building does, right? The property does. So, I mean, if you think about your parents, if your parents have lived in the same house for 10 years or something like that, if their house was a business, if you can't depreciate your house unless you use it for business purposes. But if it was a business, right, they would have bought the house for say $100,000 10 years ago, and if you're in the Boston area, it's probably worth $500,000 now. Right, and so they would have been depreciating the $100,000 house, and so 10 years later, it might be worth, on their books, if they were a business, it might be worth $70,000. I'm just doing these numbers out of my head. Might be worth $70,000, but the market value is $500,000. So there's this huge gap between the historical, because we cite historical value, and the market. The fair market value of the asset. It's possible to have a huge distorting gap between those two things. And so if you see hospitals with older equipment, an older building, like Exeter built their building, I think in 1955, right? So if you see a building like Exeter, that building is carried at historical cost. So it's reported, its gross value is reported at $1955, right? Which we all know is, like the joke now. Because you could, back in 1955, you could buy well, it didn't even exist, never mind. You could buy, a Coke for like a penny, right? As opposed to $1 today. So the value of their hospital is reported in $1955. Right? So their PPE number is way lower than what it really is, right? And so older hospitals, when we report metrics that say things like, what's your return on assets? Meaning, how much money did you earn relative to your PPE, your net PPE? Well, Exeter, because it's reporting its PPE at a number that's so historically distorted, right? they report their earnings in 2020 dollars, but their PPE, one of their big assets is cited in 1955 dollars. You're dividing, $2020 by 1955 dollars, and you get this kind of funky distortion. So hospitals and hospitals in particular with older real property tend to have higher their return on assets looks higher than it actually is as a result. Emma.
So the reason why this is depreciation value is that on that 1 year that you actually bought the land.
Right.
It doesn't look like you just lost that year buying the land.
Right.
In the case of land, they just do it. You're not splitting it up. They don't have a depreciation value on the year they use the land.
Yeah, we don't depreciate. Yeah, so we don't depreciate the land. Yeah. Right. Right. Yeah. No, they don't charge themselves for it on the income statement. So it's kind of like a free asset there. So
if you bought it in a year or two, let's say you bought the land.
Yep. Yep. You're not charging yourself for it on the income statement because it's not being depreciated.
Okay.
So you're just carrying it as an asset that's not being used up. Okay. Now, when you sell it, if you sell it, you'll have to take a gain, So if you had if it was worth $100,000, if just the land was worth 100, and then 5 years later you sell it for 500, you will have a non-operating gain, right, of $400,000, which you would then report as income. All right. So, but I won't throw you anything tricky like that. It's going to be, a building, or it's going to be stuff that has to be depreciated. Okay. So that's pretty much our long-term assets. So big long-term assets are financial assets. Those are carried at fair market value, and property, plant, and equipment. You remember, you need a gross line, right? You need a gross line, you need accumulated depreciation, and then you need net PPE. All right, so now we're going to shift to we were looking at the asset side. Now we're going to shift to look at the liability side. So liabilities. We'll start with liabilities. These are claims against the assets of the organization by lenders or creditors. Okay. So some folks who are fit into this category, everybody is in some way making you a loan. Everybody who has a liability claim against your organization is in some way making you a loan. Some of those loans don't look like loans. So liabilities, and then some of them are explicit loans. So, for example, your organization might have a mortgage. That's an explicit loan. Some of your liabilities are going to be current liabilities. So we'll get into that in a second here. Some of your liabilities are going to be current liabilities, which is what we list first. Current liabilities, which I'll abbreviate CL, as opposed to CA for current assets. Current liabilities are liabilities that are expected to be paid back in how much time? Less than a year, right? A year or less, that's going to be a current liability. Just like a current asset is something that is going to be used or could be used or liquidated within 1 year, right? So current assets and current liabilities, the magic number is 1 year, right? Something that is going to be paid either in the terms of assets, something that could be liquidated or used within 1 year, current asset. Something that is going to be paid back by the organization with 1 year, current liability. Yes? So the question was, is it within 1 year of when you obtain the asset or within the pay period? I would say just think about it more theoretically, because you could hold on to something for longer than a year. It's more about its nature than it is a particular date to date, right? So cash, you could sit on it for many years, right? And then cash is kind of like water, like, which molecule are you talking about, right? So I wouldn't worry about it specifically in terms of like date to date, rather than what's its nature, what's its fundamental nature. Is it something, is it highly liquid? So for assets, is it highly liquid? Can I convert it into, can I take it and I can go spend it pretty easily, or can I convert it into money easily? That's a current asset. Current liability, similar kind of thing. Am I going to be expected to pay this thing quickly? So one of the most common current liabilities, right, is accounts payable. Which I'll abbreviate AP, accounts payable. An account payable is, Chloe is the ward manager for 5 West, our cardiology ward. And the nurses come and say, hey, we need more gauze pads. So Chloe goes on to her ordering system and places an order for gauze pads, 1,000 gauze pads, right? 5 days later, a box of gauze pads shows up at the hospital for 5 West. It gets brought up to the ward. Chloe signs the bill, and the bill says net 30. So it's a common phrasing. Would be something like net 30. It's so say, gauze pads are cheap. So say $50, net 30. These are the terms, credit terms, under which the supplier is giving you these assets. Okay, so that's a really small order, right? So Chloe could have been ordering, thousands of dollars worth of, tens of thousands of dollars worth of chemotherapy drugs if she was working in, say, the oncology ward instead, right? And you would still have something like dollar amount, comma, net 30. What does the net 30 mean? Anybody know? Or take a guess? The lender's going to get a return? So this is a supplier, right? So this is, Allie's Medical Supplies, right? So Allie ships it to the hospital where Chloe works, and there's a bill that Chloe signs, and Allie's written on there. You owe me $1,000 net 30. So that net 30 just refers to pay me in 30 days, within 30 days. That's all that means. And net 30 is the number of days that Chloe has to send Allie a check. Net 30. So it'll be net 15, net 30, net 45, so forth. Now sometimes you'll have something like the bill is $1,000 and the terms are, say, 210 net 30. What this means is, what this is shorthand for is Allie is offering Chloe a discount if she pays within 10 days. So what Allie is offering Chloe is saying, I will give you a 2% discount if you pay me within 10 days. Otherwise, you owe me the full amount within 30 days, net 30. So 210 is a shorthand offer of a discount by the supplier to the organization. So it could be 315, you know, 17, whatever it is. The first number is the discount. And the discount applies if paid within this amount of days, number of days. Right? Otherwise, full amount. Okay, so you could see 215 net 45. You could see 320 net 60, something like it. Just kind of depends. The idea, the purpose of this is the supplier's trying to speed up the payments, the cash flow from the organization to her organization. Okay. Next category of current liabilities is accrued expenses. There's a lot of jargon here, or accruals. So this idea is very similar. So let me back up for a second. Account payable. They want their payment within 30 days. That makes it a current asset, right? So when a supplier sells your organization supplies, bandages, you know, food for the cafeteria, whatever, they're going to expect payment within a certain amount of time. Often they will have some sort of credit terms associated with it. Oftentimes you don't have to prepay for, if you're a large organization in a long-term relationship with a supplier, they typically sell it to you on credit, and you have this kind of revolving relationship where you have a sustained level of accounts payable, just like you have a sustained level of accounts receivable. You have your accounts receivable or IOUs that are owed to you. Your accounts payable are IOUs that you owe to somebody else. So then you have accrued expenses, or what I will refer to as accruals. I will use that phrasing more often than accrued expenses. What's the difference between an account payable and an accrued expense? Well, usually when we're talking about accruals, they look a lot alike, and it's easy to get them. You could argue across, and sometimes they're even lumped together. But think about this. Remember, the balance sheet is a snapshot in time, and this is the key to understanding accruals. A balance sheet is a snapshot in time. So let's say we're going to post the balance sheet as of December 31st. Now, some of you guys have jobs. So let's say you're home on winter break, and you're working at Joe's Bagel Shop, or whatever it is you do when you go home to work, right? So you're there at Joe's Bagel Shop, and you get paid every Friday. And December 31st happens to be on a Wednesday, right? So Joe's Bagel Shop, you worked from the 28th, let me see, so maybe 5 days, so 28, 29, 30, 31, 29th, so that would be Monday the 29th, right? 30, 31 is Wednesday, then you're going to work the 1st and the 2nd, you're going to get paid on the 2nd, right? So your payday is January 2nd. So Friday, January 2nd, Wednesday is the 31st. Well, the thing is that Joe has to do his balance sheet, so he hasn't paid you yet, but you've worked 3 days, because you worked all 3 days leading up to December, including December 31st, right? Cutting the bagels and toasting them and doing all the fine work that you do, right? Joe has accumulated a obligation to you. You worked 3 days. He hasn't paid you yet because he pays you on Friday. There's still 2 more days left in your pay period. But you have done 3 days of work for him, and so he has accrued an obligation to you of 3 days worth of pay. He just hasn't paid you yet. So he's doing his balance sheet. He has to account for the fact that he owes Emma 3 days worth of pay for her fine work at his establishment, right? So he owes her, I don't know, $100 or something like that, right? So, which he's going to pay 2 days after the end of the accounting period of the fiscal year. But he has to report that $100 as an accrued expense. Okay. It's a current liability, so so he's going to have an accrual, right, of $100 that he owes to Emma. And it's just a matter, in this case, it's because the ending point of the period that we're reporting on the balance sheet happens to land in the middle of a pay period. So every healthcare organization is going to have accrued expenses in the form of salaries, accrued salaries that they're going to owe, because inevitably, I mean, it's pretty unusual for, you know, everything to just line up and have, you know, December 31st land on a payday, so that the pay has been paid out, you know, and there's zero accrued expenses in terms of accrued salaries. That's just one example. Other examples would be things like utilities, right? So your utilities are running and they're keeping track of those utilities kind of throughout the course of a period. Let's say for your utility bill runs from the 15th to the 15th, as opposed to say the 1st to the 30th. So you've accrued at December 31st, you've accrued 15 days or 16 days worth of, depending on what day you actually, you know, begin your billing cycle. But if your billing cycle runs from the 15th to the 14th, then you've accumulated at that point 16 days worth of electrical bill. And so you have an accrued expense at that point of 16 days worth of electrical bill that's going to have to go into last year's accounts, even though you're going to actually pay the bill in the next fiscal year. Okay, so that's what accruals include. What's the difference between an account payable and an accrual? Well, an accrual tends to come in as a flow, right? So think of salaries, right? It's accumulating over a period of time, whereas an account payable is a discrete transaction. Chloe orders a box of supplies from Allie. That's a discrete transaction. We can draw very clear boundaries around the order that Chloe placed. Whereas, you know, Emma is working at the bagel shop, right? And is essentially a flow of services that she is selling. If you could think about it, wages is basically the worker selling their labor to their employer, right? So that's a flow of services that Emma is providing to Joe's Bagel Shop. That if the reporting period breaks in the middle of the pay period, then she's accumulated, Joe's Bagel Shop has accumulated an obligation to Emma that has to be captured in the year that it was provided, right? Rather than carrying it over and charging her the full amount, because it's on accrual basis. It's on accrual basis, right? As opposed to cash basis. If it was a cash basis situation, then we would just pay her, right? We would recognize the expense in the next fiscal year. But because we're on an accrual basis, we've got to break that and say the obligations were earned in 2020, but we're really going to pay her, you know, those days in 2021. Okay, Emma, question.
On the balance sheet, does accruals go under account payable, or do you use other?
It's a separate line. So you would have accounts payable and accruals. So it'd be, you know, accounts payable, accruals, right? So it'd be just, you know, current assets, and you just keep going down. Okay, it is a separate category, though it can be reported. Again, like a lot of times, I keep talking about this, like depending on how it's reported, you know, depending on the granularity, they may not break it out. It may be accounts payable and accruals all in one line. We're going to treat it as two separate things. Sorry? No, there's no accruals on the asset side. Yeah, okay, I see what you're saying. So like if you, yes, yeah. So yeah, if you have Yeah, okay, that's an interesting point. I hadn't thought about that. But yeah. So if you have if you're providing a service with like a flow nature to it, it's going to be all accounts receivable. Okay. So we have accounts payable, accruals. We can also have current portion of long-term debt. This is kind of technical, but let's try to think about this for a second. Let's imagine you have a mortgage, or a lot of you have car loans, so that's easier for maybe for you to wrap your head around. Your car loan, let's say, is for 5 years. That makes it a long-term liability because it's more than 1 year. However, you are making payments in the current year, right? So let's say you make $100 a month in car payments. Over the that your car payment is $100 a month. Because there's a declining balance. Some portion of your $100 a month is towards principal, and some portion of it is towards interest. The interest is an expense and gets reported in the income statement. The current portion of long-term debt is the principal portion of your payments and gets reported here as a, sorry, that should be current liabilities, not current assets. The current portion of your long-term debt gets reported as a, the portion of your payments that are due this year that are towards your principal get reported as current portion of long-term debt. So let's imagine, let's just do this super simple, even though it's not accurate, right? So you have a $100 payment each month. Let's imagine that there's a constant $80 towards principal, $20 towards interest. Now, this is the fiction. It's constantly changing, right? And we'll get into that later on. But we'll get into that in chapter 9. I'll show you how to actually calculate a mortgage payment schedule. Okay, but let's say, just to simplify our example, that this is the constant relationship. So in this year, right, the current portion of your long-term debt this year, you're going to pay $100 a month. 80 of that is going to be toward principal. That's what gets carried here. So you would take 80 times 12, which would be 106,000, oh boy, 800, 1,000, help me out, guys. 10 times 800, 10 times 80, it's 800, 2 times 8 is 160, 960? Yes? Okay. Y'all are just like, let's make him sweat. All right, so so the current portion of your long-term debt would be 960. If this was a 5-year loan and you had this constant arrangement of $20 in interest every month and $80 in principal, you'd be making 5 years worth of payments. So that would be 960 times 5. So your car loan would be $4,500 plus $300, $4,800, right? So your total loan would be $4,800. That would be 960 of which would be the, make sure I'm doing the math right. 5-year loan times 12 times 80, yeah, 4,800. So the total loan would be 4,800, right? 960 of it would be the current portion, meaning that's the portion of the principal that you're going to pay this year. That would be the current portion of the long-term debt. So the rest, the long-term portion, would be 3840. We will do that next. So then we have long-term debt or long-term liabilities. Let's call it liabilities. If you say debt instead of liabilities, I won't hold you to that. Typically, long-term, anything long-term is debt. So long-term liabilities, we would have the long-term portion of debt. In this case, we had a $4,800 loan minus the $960 that's current, we'd have $3,840. Right, so that's the long-term portion. That's the portion of the loan that's not due this year. That's the principal that's not going to be paid this year. So we split it. If we have a long-term loan, we split it between what's current and what's long-term. Okay. Now we're into long-term liabilities. So we have long-term liabilities, right? So we had current liabilities, long-term liabilities. So we have long-term debt, long-term portion. Yeah. And remember, the interest portion doesn't show up on the balance sheet, right? The interest portion is an expense. It goes on the income statement. So the only part of the debt that we care about for the balance sheet is the principal portion, right? So if you have a car loan and you're making those payments, right? If you have a $100 payment and $20 of it is interest, the only portion that we care about for the balance sheet is the principal portion. You could break out long-term debt in a couple of different ways. You could have long-term debt. You could have mortgages. You could have bonds. These are all basically long-term debt. And depending on the level of detail that the organization wants to get into, they may split up. Hey, we have this mortgage with this bank, we have a bond issue, we have something else, right? Or they could just compress it all down into debt and just say long-term debt is this amount. So it really depends on how detailed this statement is, okay? On the test, I will make it obvious to you, but you need to kind of get used to organizations, depending on the financial statement you're looking at, you have to recognize that they may be providing you a more summarized view or a more detailed view. Okay, so that's all of that would be added together to get, you would add the current liabilities, right? You would have total current liabilities. Yeah. You would have current liabilities, right? And you would have your accounts payable, your accruals, current portion. That would all get total current liabilities. And then you would have things like long-term debt, maybe a mortgage or bonds. Then you would add all of this together, including the current liabilities, and you would get your total liabilities, okay? So that's, all right, so you have total liabilities. So remember, you have, the balance sheet is assets, and then liabilities and owner's equity, right? So we've done now the liabilities portion, we're gonna now do owner's equity. Okay. So a for-profit entity, this gets different. So everything we've done so far in terms of assets And liabilities are essentially the same across both for-profit and not-for-profit. The equity accounts look a little bit different depending on, well, they look a lot different for-profit and not-for-profit. So we're going to do that owner's equity portion. We're going to have under, if you see, so owner's equity is going to be broken down into common stock. This is a basic breakdown. Common stock, and then retained earnings, which we talked about in the changes of owner's equity statement before. For those are going to add together to get total equity. Okay. Common stock account. Common stock account is the value of the resources contributed. So common stock, value of resources contributed by shareholders. So let's imagine that Caitlin and Megan decide to start a business. They're going to start manufacturing medical equipment, right? So they each get together and they say, you know, we've been highly successful healthcare executives for the last 20 years. We're going to start our own business. We each are going to contribute $500,000 to the business from our personal savings. Okay? Those 500, so they each contribute $500,000, and then they create a company. So they create a corporation. They create a corporation. They each contribute $500,000. The corporation now has $1 million in common stock, right? And so they each get, you know, they make up some number. This is where, like, how many shares of stock do you have is a thing that you guys decide. So they could say, you know what, we're gonna each contribute $1 million, and so we're going to decide that that represents 100,000 shares of stock. So each share is nominally worth $10. Has a nominal $10 value, right? Each share of stock. So we have 100,000 shares. Caitlin has 50,000. Megan has 50,000 shares. Number of shares doesn't matter. What matters is how much money did they contribute to the organization. That becomes the common stock value that we capture here on this line. Okay, and if Taylor decides to join the company later, and Megan and Caitlin say, you could join in, but you have to, you know, the cost of joining in is going to be, you have to contribute another $500,000 to the business. Well, then you would add another $500,000 to the common stock, right? And Caitlin and Megan may do that. They get, you know, they get the business going, and they realize, you know what, we really need more money. We really need more cash. One way we could do that is to sell a third of the business, you know, basically to Taylor. And so we say, Taylor, if you contribute $500,000, we'll give you 1/3 ownership. And so we'll just magically create another 50,000 shares of stock. And so we each will have 50,000 shares of stock. We'll each be 1/3 owners, but you have to contribute $500,000. So that 1 million would then go up to 1.5. Okay? It's pretty simple. The key difference between common stock and retained earnings is common stock is a contribution by the owners, right? Retained earnings is that extra money that's left over, the net profit. Remember from the income statement, right? We had our revenues minus our operating expenses, plus or minus our non-operating gains or losses, depending on if it's a gain or a loss, right? That leaves us with our net income. And then if it's a for-profit, we decide, you know, so Caitlin and Megan maybe decide, do we want to, if we had a profit, do we want to pay ourselves a dividend, or do we want to or do we want to reinvest all the money? So if they had, let's say, $500,000 in net income last year, and they said, you know what, we're just filthy rich from our 20 years of working as highly successful healthcare executives. We don't need to pay ourselves a dividend. We're going to retain all of the earnings. So if they had a net income of $500,000 and they decide to retain all of it, that becomes $500,000 in retained earnings. And so that would be reported here as retained earnings. So after the first year of operation, at the beginning of the year, they would have started the corporation. They would have contributed $1 million. That creates the initial common stock value. At the end of the year, they've earned $500,000 in net income that they decide to retain in the business. So at the end of the year, they have the $1 million in common stock that they contributed at the beginning of the year, and then they have the $500,000 in profits that they have decided to retain. So they have 1 million plus 500,000 gives them an equity account of 1.5 million. Now, if Taylor joined, we would have had 1.5 million up here, and then it would have been 2 million, right? There's two on a for-profit statement of owner's equity. There are 2 lines. It can be more complicated than this, but in our simplified world, there are going to be 2 lines. There's going to be a common stock line and a retained earnings line. The common stock line increases based on contributions by the shareholders. The retained earnings line increases as you make the decision to retain earnings. Okay? So that would be the complete for-profit statement. So for-profit would have assets, current assets, long-term assets, total assets, liabilities and owner's equity. They would have current liabilities, long-term liabilities, total liabilities, common stock, which I'll abbreviate CS, retained earnings, RE, for total equity. Then you add these 2 together to get total liabilities and owner's equity, which is going to be this plus this. Right? So it's just adding these 2 lines. But that's basically what a balance sheet would look like for a for-profit entity. The difference between a for-profit entity and a not-for-profit entity is going to be that their equity, owner's equity section is going to look different. So this is going to, the assets are going to look the same for a not-for-profit. The liabilities section is going to look the same for a not-for-profit. The difference is going to be in the statement of equity. So instead of equity for a not-for-profit, you're going to have this thing called net assets. And this terminology is terrible because it always confuses everybody. I don't know which genius it was that came up with it, but it's really bad terminology. Because everybody starts to want to do some sort of netting, particularly students want to do think net assets refer to assets. Really what it refers to is, remember we said assets equals liabilities plus owner's equity, right? And then we said, well, you could do assets minus liabilities equals owner's equity. Because we don't have owners with not-for-profits, we don't have owner's equity. Instead, the way we express it is we say assets minus liabilities equals net assets. And that's how we refer to the equity in a not-for-profit. We refer to it as net assets. But it's not an asset, right? It's just basically whatever's left over, whatever value is left over after you take the asset, the value of the assets, and you subtract off the liabilities. So it's not really assets, right? It just means what portion of the assets belong, in essence, to the community, you know, that the not-for-profit represents. So net assets is equal to owner's equity for a not-for-profit. It's the same thing. So when you hear net assets, you shouldn't be thinking, oh, I'm talking about the left side of the balance sheet. I'm talking about assets. You need to kind of train your ear to you need to train your ear to hear, I'm talking about owner's equity here. I'm not talking about assets. Yeah, Emily. So yeah, so this, when I say assets, I'm referring to total assets, right?
The right side is net.
Yeah, on the right side, it's going to be net assets, which is really just the value that's left over after we subtract the value of the cost of the liabilities from the assets. Okay. So what does the net asset account look like? So we're going to have net assets. And then there are three categories of assets, of net assets. There are unrestricted, there are temporarily restricted, and there are permanently restricted net assets. You add these three categories together and you get total net assets. See, and even there now you're talking about total net assets. Like it doesn't even, that doesn't, you know, if you think about it, that doesn't even make any sense, right? So, but that's how we write it. So let me talk to these two first. And basically unrestricted net assets is like retained earnings. So the kind of the analog on the for-profit side is unrestricted net assets is like retained earnings. Temporarily restricted assets and permanently restricted assets are some form of donation, so keeping track of some form of donation. So Deb makes tons of money as a pharmaceutical, you know, mogul, and decides to make $1 million donation to Wentworth Douglas when she retires, right? And she says, I'm going to give you this $1 million, but with strings attached. You can use this $1 million when you are ready to build a new cancer care wing. And the condition is you can use my $1 million when you build the cancer care wing and you name it the Deb Cancer Care Wing, right? So that's a temporary restriction. They've got the money, they put it in the bank. She's given them the money, they've put it in their bank, but they can't spend it until they can meet those requirements. When they meet those requirements, right, that's when it moves from being a temporarily restricted to an unrestricted asset. So as long as they're meeting the requirements that Deb has put in place, right, it transitions from temporarily to unrestricted, and it shows up as income in the year that happens. So that happens all the time. They're constantly getting, here's $1,000, you can use that towards, you know, nursing, continuing education, or something like that, or paying for some poor child's care, or something like that. So they get donations all the time with strings attached. Then they sometimes get donations that are permanently restricted. These are meant to create a corpus, meaning a certain amount of money for the organization that they keep on hand forever, right? And and what they often will do is Deb, instead of saying, I'm going to give you $1 million so that you can build the Deb Cancer Wing, I'm going to give you $1 million and you can take the interest off that forever, right? But I want you to have that $1 million as an asset so that it kind of creates the basis of the organization, the basis of the organization's financial strength. Okay, so unrestricted assets is the best analog, the approximate analog is retained earnings. So when a not-for-profit has a profit, right, because not-for-profits still can have profits, when a not-for-profit has profit at the end of the year, they can't pay out any dividends because, right, they are not allowed to. That has to be retained. So if we have a not-for-profit and it makes $1 million over the course of the fiscal year, that money has to be retained. That money shows up on the balance sheet in the unrestricted net assets equity account. Okay. All right, we've covered the entire balance sheet. Next time we'll talk about some transactions. Have a great weekend.